So should you invest a chunk of money all at once or should you spread it out over time? That is the subject of today's video, dollar cost averaging versus lump sum investing. It's $1 million question. I see a lot of clients struggle with this one for sure. So in today's video, we're going to get into it, break it down a little bit and work out the best solution for you. So first of all, let's define what dollar cost averaging is, or pound cost averaging for people here in the UK, and lump sum investing. Okay, so dollar cost averaging is really where you have a specific plan for a set amount of time that you wish to take a chunk of money and get it invested into the market. So let's assume, in a simple example, you have $12,000 and your goal is to get all of that $12,000 invested into the stock market. And you've identified, let's say, an index fund or an ETF that you wish to invest into. Okay, so you've got $12,000. With a dollar cost average, you might divide that by 12. So you have $1,000 each month that you will invest into the stock market, into your favorite ETF or index fund. And what you would do is just log into your brokerage account, maybe at the beginning of the month, every single month, and buy 1,000 no matter what's gone in with the market. So that at the end of 12 months, you would have the full $12,000 invested in the stock market as you wish. And this can be a tool that's used to reduce your risk compared to lump sum investing. So what is lump sum investing? Well, it's very straightforward. As opposed to taking the $12,000 and investing $1,000 every month to get it invested into the market, with a lump sum investing, you would just take the $12,000, log into your brokerage account, press buy for the full $12,000 and into the market you go, and then whatever happens from there happens. So that's lump sum investing. A lot of clients that I talk to and I speak to, clients all day long throughout the week, really struggle with this one. When they have a lump sum of cash on their account, they want to get it into the market. They're afraid, however, that buying now, particularly with the markets at all-time highs that they have been over the last few days as I'm filming this video, but they're scared to put it in and they're not really sure what to do. So let's get into some information on this, break down the data a little bit to see what's best, because Vanguard has done a great study on this. But after that, I'm going to get into what I really think somebody should do. And that's based on my time of 20 years talking to clients and people just like you and the mistakes that I see. Okay, I see it very clearly. So stick around towards the end of the video. We'll get into my opinion versus the data. So on the screen in front of me, I've got the Vanguard study that I mentioned a minute ago, where they've gone in and gone through the data, crunch the numbers and come out with a result here. And basically, according to them, what they see is that lump sum strategies actually beat dollar cost averaging 2/3 of the times that they tested this, and 2/3 of the times depending on market environment or market scenario. And this is according to historical and simulated market data. Okay, but despite the expectation of lower returns, dollar cost averaging might be considered for investors with very high risk aversion to both risk and losses, who might be tempted to hold a lump sum entirely in cash. So let's get into it a bit further and see what all of this stuff means and how they've come to this conclusion. I made a few highlights here, some key points, but basically if we look at the first one here, the result is consistent with the fact that over a period from 1976 to 1922, US stocks and bonds have outperformed cash. So there's nothing particularly surprising here. We know the markets, particularly the S&P, has returned around 9.8% historically, and that is definitely more than cash or short-term government bonds or treasury bill rates like they used in this case. Okay, so therefore, it's not that surprising that a lump sum investing strategy would outperform dollar cost averaging. Why? Because time in the market beats trying to time the market. And therefore, if you put all your money in and you let it go over the long term, therefore you should have a better return than if you spent it, in this case, 3 months, took 3 months to dollar cost average in. In this study, they just use an example of 3 months to cost average into your investment. So here with the lump sum, you're invested for 12 months, and then here with cost averaging, your first 3 months are you averaging in, and then only 9 months where you're fully invested. So that's where the difference lies. Okay. Another thing to take away, although cost averaging strategy won't on average produce higher returns, it is superior to remaining entirely in cash. Okay, we know that cash pays very little, so you're better off dollar cost averaging than you are holding in cash in fear of going into the market. But as we see in the study, going in on a lump sum and holding it will produce slightly better returns. Okay, Lowering the risk could limit the drawdown and the accompanying investor regret in a severe market downturn, thus preserving commitment to the investment plan. So this is where dollar cost averaging is maybe better than when you're using lump sum investing. By lowering the risk through dividing your money up by 3, 6, 9, 12 months, you therefore will remove any regret or anxiety or feelings that you have, strong emotions around the stock market of having bought at the worst possible time. So that can be the benefit of cost averaging strategy. Okay. But how big of a difference is it when you invest in a lump sum or whether you use a dollar cost average strategy? Well, here we look, let's take the 100% equity portfolio as an example here. And what you'll see, the 95th, 75th, and 50th percentile are the better market environments, whereas the 25th and the 5th percentile is where the markets performed worse. And as you can see, except for when the markets had their worst environments, all others, the lump sum investing, putting your money in all in one go, slightly outperformed the cost averaging strategy after 1 year. Okay, and in the best market environments, it outperformed by quite a lot. As you can see, the difference between these two numbers, 139,000 and 131,000. Okay, so no surprise, when the markets are going up and the markets are hot, putting your money in all in one go outperforms averaging it over a set period of time. But again, this makes sense because time in the market to capture those returns is better than trying to time it or missing some of those returns. Whereas if the market is in a down environment, of course, the longer you take to go into the market, the better your return will be. So again, nothing surprising here. Ultimately, what we see through this study, without a doubt, is that investing a lump sum and then holding it is actually a better return, but it's not by much, as we saw in the numbers just a moment ago. Okay, so having looked at that study, it's pretty clear that lump sum investing is the better way to go, purely thinking of returns and looking at the data. But here's my thoughts on why this may not be the best strategy, and in fact, not something I would recommend for you. And that's because the vast majority of people lose control of their emotions when it comes to investing in the stock market. There's so much money on the sidelines just in fear of putting it into the market and the market selling off because you've put your money in at the worst possible time. So when you factor in the human emotion, which in my opinion, is probably 70, 80, maybe even 90% of a person's returns on their account, then I think dollar cost averaging is a better way to go. It will give you peace of mind for your investment, and you won't have that feeling of, I put my money in, is the market going to sell off all of a sudden on me? Let me tell you a story to put this in real life. I recently had lunch with a client just this past week, and I met up with her a few months ago where she wanted to learn about options and explain the fundamentals of options, which I may do a video on at some point. We had her strategy, had it all laid out. She immediately put all the money that she wanted to get into options into the market at that meeting. Bought lots of call options on lots of stocks. And the plan was to hold these options for a 2-year period. I think it was a smart move, to be fair. But here's what happened. August came around, the market sold off drastically, if you remember. Japan was down 7%. Nvidia and other of those highly priced tech stocks in the US sold off really hard, and guess what she did? She panicked and she sold, and she booked a loss that was around 40% of her account value. This is a catastrophic result, but one that I see all too often. She went into the trades with the right frame of mind, the right strategy, the right plan, but emotions, the headlines, the negative news media took over. That is what led her to sell off her positions. And of course, those positions, if she held on to them today, the market returning to all-time highs, she would be in some really nice juicy profits. And I see this over and over and over again. Two things: people sitting on the sidelines because they're afraid to get money invested, or they panic sell. And you only do that because your emotions take over. And that happens because you've got too much in the market at one time. Even Warren Buffett, the most seasoned investor perhaps of all time, if you recall, when he was purchasing his Apple stake, he did it over a 2-year period. He just averaged into the market over a 2-year period. And he recommends that strategy as well. And I can tell you, if you want to save yourself a lot of grief and a lot of headache, don't do a lump sum investment. Do a dollar cost average. I don't suggest 3 months or 6 months even. For me, I would suggest you do 12, 18, potentially even 24. Another thing that I would suggest you do, Let's say you have, in our example, $12,000 you want to get into the market, and you decide to dollar cost average in at 1,000 every month. What I would do is, let's say you're in month 3 of this plan and you're about to invest 1,000, but you see that the market is down 5% or more from the last month where you invested $1,000. If I were you, I would add another 10 or 15% on. So instead of investing 1,000 in month 3, I would do 1,100, for example, or 1,200, because the market's down and you're going to add more. Okay, and let that follow through. Perhaps if the market is up 10% at month 3, maybe you only want to put in $800, for example. And like that, you'll be taking advantage of those moves and buying even more when the market is down and buying less when the market is up. Most importantly, this will give you peace of mind. And that to me is the most important thing, because I've seen it many, many times where people's emotions get the better of them, and it's, like I said, catastrophic for your portfolio. Look, I'm really passionate about this stuff. Hopefully you can tell, and this comes across in these videos. I love doing videos like this to help you understand all of the things that I've gained over my last 20 years working with clients and individuals, seeing what works and what doesn't, like the story I shared a moment ago. So that's why I've done other videos like this. Here's a video that I've got on ETFs and index funds and mutual funds as well. Have a look at that, and I'll see you over there.